Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Imagine you live in a city that has only 5 companies and their combined revenues is rupees 100 crores. Now these 5 companies are also listed on the stock exchange and are valued at rupees 300 crores combined. So while the companies generate revenues of rupees 100 crores, they command a market value 3 times higher, that is 300 crores. Now there's another city nearby which has 7 companies and together they generate a revenue of rupees 150 crores. So they generate roughly 50% higher revenues than the first city. Now here comes the shocking part. The second group of companies are also listed on the stock exchange, but they are valued at a whopping 7,500 crores. Yes, that's correct. Despite generating only 50% more revenues than the first group, they're getting a close to 25 times higher valuation. Is this scenario even possible? Can one group of companies be worth almost 25 times more than the second group despite generating only 50% more revenues? Well, a similar situation is playing out in the real world. And the two countries at the center of this are United States and China. You see, economically, China has done phenomenally well over the past 3 decades. In fact, it has grown so fast that its GDP is only about 33% lower than the US, or in other words, the US GDP is 50% higher than China's. However, it is the market cap of the two nations that is evoking shock and awe across the world. If a global stock market study is anything to go by, it will be fair to say that the US is eating the rest of the world for breakfast, lunch, and dinner. The country's market capitalization as a percentage of the global market cap is close to 70% currently, although it makes up just 26% of the global GDP. China, on the other hand, which is a close second in terms of GDP at 17%, accounts for less than 3% of the global market cap, whereas ideally it should have been at least 17%, if not more. Let me repeat that again. US contributes 26% of global GDP but makes up nearly 70% of its stock market capitalization, while China contributes 17% to GDP and yet makes up less than 3% of global market cap. Agree that the US has a much better reputation than any other country when it comes to political stability, regulatory environment, and protection of ownership rights. However, this alone does not explain why investors are buying US stocks hand over fist. They are also buying them in anticipation of steady earnings growth and capital appreciation. It is simply staggering how, despite its enormous size, the US economy continues to chug along at a decent pace, thus continuously producing more output and also creating more wealth and prosperity for its citizens. Be it productivity growth or launch of new businesses and industries, the US has a significant lead in these areas over its developed counterparts. Little wonder it continues to be a magnet for stock market inflows. What about India though? Where does our beloved country fit into this overall scheme of things? Is it the sulking brother that gets a much lower share in property as compared to his contribution, or it continuously punches much above its weight like the US does? Well, of course, our position is not as good as the US, but it is not as bad as China either. It won't be wrong to say that we are being treated quite fairly at the moment. India currently constitutes 2% of the global market cap while contributing 3.4% to the global GDP. Thus, as just highlighted, although there is a scope for improvement, our situation does not seem to be as bad as the Dragon Nation. Having said that, we certainly cannot rest on our past laurels. We should certainly look for ways and means to take this ratio higher in the coming years. What will it take though? How do we continue to attract both domestic as well as foreign capital so that even more stock market wealth is created? Well, one factor that can make a huge difference is the industrialization of our economy, or to put it differently, increasing the share of manufacturing in our overall GDP. As per data, out of our total labor force stock, only 11% are in manufacturing. And guess what? Agriculture still employs a significant 45% of our total labor force. Hence, the goal should be clear to move as many people as possible out of farms and into factories. Now, India may not get to the 40 to 45% peak labor force into the manufacturing sector of developed economies, but we can still try and get at least 25% of the total employment into manufacturing. It should be noted that India's consumption driven growth and too much dependence on the service sector is already showing signs of fatigue if the recent GDP data is any indication. Government spending and investments in infrastructure can only help so much. But if we have to sustain a GDP growth of at least 7% to 8% in the long term and lift millions more out of poverty, then manufacturing has to step up. We've already created the world's largest democracy and a well functioning capital market that can give any developed nation a run for money. Now we need high output factories so that our workforce gets more productive and ushers in a new era of high GDP growth as well as robust stock market wealth creation. What does this mean for your stock market investment? Well, if we have to keep earning good long term returns, the Indian economy and its companies need to keep growing at a good pace. And for this to happen, a third revolution in the form of manufacturing must happen. We've had the green revolution, that is the agri revolution. We've had the services sector revolution, that is the IT revolution. Well, now it is time for the third revolution, that is the manufacturing revolution. Any delay here and the stock market may not like it. Markets have already been wobbly of late as the macro numbers have not been good. So do keep an eye out and take the appropriate action in your portfolios based on how the macro numbers pan out. This brings me to the end of today's video. I'll see you again next time. Goodbye and happy investing.